Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host Sandeep Rao. In our last episode, we explored the idea of backtesting, what it is, the key metrics you need to track, and we even compared Nifty versus gold using a sample backtest. Today I want to shift gears a little and talk about something that often gets overlooked yet sits at the very foundation of trading and investing. I call it the horses for courses problem. Here's what I mean. Every financial product is designed with a very specific purpose in mind. Or to borrow from the tech world, each product comes with its own use case. If you want to get better at trading or investing, you need to understand the toolkit available to you and what each tool is meant for. Because honestly, there's no sense trying to climb Everest in sneakers. In this episode, I want to give you the lay of the land when it comes to financial products. What all products do we have in India that can be used in the context of trading? So let's start with some broad categories and then we will drill down into individual products. At the highest level, you can think of financial products in four big buckets. Listed equities, which include stocks, equities, ETFs, REITs and InvITs. Listed debt, which includes debt ETFs, G-SECs, corporate bonds, PSU bonds, etc. Mutual funds can be equities, debt, hybrid, thematic, all of that. And then lastly, derivatives. These are leveraged products like futures and options that have an underlying of either stocks, indexes, or commodities. For our context, I'm sticking only to products that can be dematerialized or are exchange traded. Let's start with the basics. Listed equities. These are primarily meant for long-term investing but can work well for trading positionally and for intraday long-short strategies. On an intraday time frame, equity long and short positions can be traded with leverage. And yes, in India, we cannot short stocks overnight. Also, it's worth noting that we now have a financing or funding mechanism called MTF, which helps in positionally trading stocks with leverage. Now here's the interesting part. Because equities are fully owned and dematerialized, they also serve as collateral. You can pledge them and unlock margin for other trades without selling them. In other words, they work both as your base portfolio and as the foundation upon which you can build tactical derivative positions. I must mention that REITs and InvITs are an exception to this rule. Though they are exchange traded, they do not qualify as collateral for pledging. The next category of products are listed debt instruments, things like liquid ETFs, government securities, and corporate or PSU bonds. Just like equities, these are primarily investing products meant to provide stability, predictable returns, and income through interest. But they also play a second role. Many of these instruments can be pledged as collateral provided they appear on the approved list of the clearing corporation and your broker. That's an important distinction. Simply being listed doesn't automatically make a bond or a debt ETF pledgeable. Clearing corporations publish eligibility lists each month based on criteria like liquidity, credit quality, and trading history. So while a liquid fund, a gilt fund, or a G-SEC in demat form may qualify, a small illiquid bond issue or a new mutual fund scheme may not. This is where the horses for courses idea shows up again. Debt instruments give you long-term stability and income, but when pledgeable, they also form part of the collateral foundation that traders can build upon. A good practice here is to always cross-check with your broker's pledgeable securities list before investing. Your portfolio might hold 10 different debt funds, but perhaps only 3 appear on the pledge list. You may own a corporate bond, but unless it's on the approved ISIN list, it won't count as collateral. Knowing this upfront helps you design a portfolio that can serve both as an investment base and as a margin engine. The next category of products are mutual funds, which are among the most familiar and cost-effective ways of investing in equities. Mutual funds come in two forms: demat units or SOA units. SOA stands for Statement of Account, or they are physical units. From a pledging standpoint, only demat units are eligible. If your holdings are in SOA format, they can be converted to demat, and I'll share the resources on how that works. For a retail investor, mutual funds are often the simplest way to participate in markets without worrying about individual stock selection. If you think equities will grow over the long run, you can invest in an equity fund. If you prefer stability, you might choose a debt fund. And if you want a mix of both, hybrid funds are available. The advantage here is professional management and diversification. With even a small investment, you get access to a broad portfolio that would be hard to build on your own. One of the most popular categories today is the index fund. Instead of trying to beat the markets, these funds simply track a benchmark index like Nifty 50 or Sensex. They are low cost, transparent, and are often the go-to choice for long-term wealth building. Mutual funds are also handy when it comes to goal-based investing. Imagine you want to save for your child's education 10 years away. Instead of directly picking stocks or bonds, you could set up an SIP in a balanced, equity-oriented, or even an index fund, letting compounding and asset allocation do the heavy lifting. Some investors even use sectoral or thematic funds, say a technology fund or an ESG fund, if they have a strong view on specific trends. That's a more advanced choice, but mutual funds make it accessible. Once held in demat form, they can also be pledged and used as a base over which you can layer derivative positions. It's worth noting though that not all mutual funds are pledgeable, and even for those that are, the haircuts, that is, the margin reductions applied when pledging, can vary significantly. I'll explain that in detail. So whenever you pledge collateral, be it stocks, ETFs or mutual funds, you don't get a margin equal to its full market value. If you pledge an asset worth 100, you may receive a credit only for 90. The difference, in this case 10 rupees, is called the haircut. This haircut serves as a safety buffer for the broker and the clearing corporation, protecting them if the value of your pledged security falls. One way to read the riskiness of a security is by looking at its haircut percentage. Higher the haircut, the higher the perceived volatility or liquidity risk. Think of a haircut as a security deposit your landlord keeps back. You pay the full rent, but a part of it is held aside as a cushion in case something goes wrong. Similarly, when you pledge securities, a portion of the value is set aside to safeguard against sudden drops. I'm sure some of you may wonder, under what circumstances would the broker liquidate your pledge holdings or securities? Say you pledge securities worth 1 lakh and the broker gives you 90% margin, that is 90,000 rupees. If your losses eat into about 80% of this funded amount, which is close to 72,000, the broker will start sending alerts. If losses continue and the coverage drops further, the broker may liquidate your pledged securities. However, if you add funds in time, your position will remain intact. Please do note, the 80% threshold mentioned here is only an example. The exact levels can vary from broker to broker depending on their risk management system, or RMS as it's called. With the concept of haircut done, let's understand the two categories of collateral securities, cash and non-cash. Certain products like liquid funds and gilt funds are treated as cash equivalents. That is, for margin purposes, they are considered the same as keeping cash in your broking account and count towards the cash component requirement for positional trading. I know this can sound a bit technical, so let me simplify. When you carry derivatives positions overnight, whether futures or options, exchanges require only 50% of the margin can come from pledged non-cash collateral. The other 50% must come from cash or cash collateral. Here's an example. Suppose you take a long futures trade that requires 2 lakhs in margin. You can find 1 lakh from pledged assets like index mutual funds, which is non-cash, but the remaining 1 lakh must come from cash or cash collateral. The idea is, instead of letting cash sit idle, you can invest it in instruments that qualify as cash equivalents, liquid funds, gilts, GSECs, etc., and still meet the 50% cash requirement. This way, your capital works harder without breaking the rules. Now, an important nuance. For intraday trading, this 50% cash requirement works differently depending on your broker's terms. At Zerodha, you can fund the entire margin with collateral, obviously subject to haircut, but the moment you carry the position overnight, the 50-50 rule kicks in. However, it's important to note that the clearing corporation blocks margins of 50-50 for all positions intraday and overnight. It's the broker who funds the 50% cash for intraday positions. In case there is any shortfall of cash, some brokers will charge an interest on the shortfall. This is why I stress so much on the collateral strategy. Novice traders often obsess over trading setups but ignore these foundational cash management rules that can quietly improve capital efficiency. In fact, most professional traders I've observed flip the problem around. First, they decide how much market exposure they want. Then, they allocate into funds or ETFs with the lowest haircuts on the non-cash side. Next, they calculate their cash requirement and park it in cash equivalent products with the lowest haircuts. Finally, they maintain a cash buffer specifically for mark-to-market losses. This systematic approach creates a strong foundation allocation on which derivatives trade can be layered effectively. So far, we've explored listed equities, listed debt, and mutual funds, and how they can also serve as collateral for margin requirements. Now, let's move on to the next product categories, derivatives. In India, the derivatives market is primarily made up of futures and options. I won't go into the mechanics of how these contracts work. There's plenty of excellent material on Varsity, and I'll share that in the show notes. Instead, I'll focus on where and how futures and options fit into the bigger picture. Derivatives in India are available on three major exchanges: NSE, BSE, and MCX. They cover three broad categories of underlying assets: indexes, single stocks, and commodities. We'll explore all the derivatives available on each of these exchanges. Let's start with NSE. On the index side, there are five main products: Nifty, Bank Nifty, Mid-Cap Nifty, Fin Nifty, and Nifty Next 50. For each of these, you'll find both futures and options contracts. Futures are listed for the current month, the next month, and the subsequent month expiries. Options work a little differently. On Nifty, you will find contracts across weekly, monthly, and quarterly expiries, as well as leaps. These are long-dated options that can run for a year or more. These leaps open the door to some very interesting low-risk strategies, which I'll cover in future episodes. Nifty is the only index where leaps are available with some liquidity. For Bank Nifty options, monthly contracts exist, but beyond the current month, liquidity drops off quickly. The same is true for Mid-Cap Nifty. Liquidity in Fin Nifty and Nifty Next 50, at least for now, is too low to make them practical for trading products. NSE also lists single stock derivatives, both futures and options, on about 220 stocks, though liquidity varies from one stock to another. Beyond equities, you'll also see derivatives on currencies, interest rates, and commodities. But here the participation is extremely limited. Currency derivatives have restrictions on who can trade, and the others are largely illiquid. Now moving to BSE. Here too you'll find index derivatives on Sensex, BankX, and Sensex 50. Of these, only Sensex has meaningful liquidity, with both weekly and monthly contracts actively traded. The others are technically listed but don't see any real volumes. BSE also offers single stock futures and options, but again liquidity is a major constraint. In addition, BSE has experimented with some more exotic contracts like index future spreads, equity future spreads, and provisional options, but these products haven't gained traction and remain illiquid. Finally, coming to MCX, which is focused on commodities. Here, you'll find futures and options on products like gold, including Gold Mini and the 1 gram Gold Petal, silver with Silver Mini and Silver Micro, crude oil and Crude Oil Mini, and Natural Gas and Natural Gas Mini. While options are available, liquidity is generally much better in the futures contract. Some commodities like aluminium, copper, zinc, electricity, and cotton oil are available only in futures form with no listed options yet. What you see here is a comprehensive list of all the derivatives traded in India. But it's worth noting that while the list is broad, not every contract is actively traded. Some have very low liquidity. Now, extending our horses for courses idea, let's look at the use cases for futures. To do that, we need to take a quick detour into a key concept called delta. Delta simply tells us how much the price of a derivative changes when the price of its underlying asset changes. In the case of a futures contract, the delta is always 1, meaning it's a 1:1 relationship. Here's a simple example. Suppose Reliance is trading 1,400 today. Over the next few days, it rises to 1,450. That's a 50 rupees increase in the underlying stock price. If you were holding a Reliance futures contract, the price of the futures would also move up by the same 50 rupees. This perfect 1:1 movement is what we mean when we say the delta of a futures contract is 1. Of course, you can't buy just one share using futures. Each contract comes with a lot size which defines the minimum tradable quantity. For Reliance, the lot size is 500 shares. So when you buy a single lot of Reliance futures, you are essentially taking exposure equivalent to 500 shares. The same thing applies to index and commodity futures as well. I'll share a Varsity link which explains this concept well. Now that we understood the idea of delta, lot size and contract value, let's move to the bigger question. What are futures actually used for? To make it clear, I'll separate this into how retail traders use them and how institutions use them. For a retail trader, futures are often about taking leveraged directional bets. If you think Reliance is headed higher, you can go long on the futures contract. If you expect it to fall, you can go short. The advantage here is that you don't have to put up the entire contract value. With margins typically around 15 to 20%, you can control a much larger exposure with relatively smaller capital. Futures are also handy when it comes to hedging. Imagine you own 1,000 shares of Reliance for the long term, but you're worried about short-term weakness. You could short 2 lots of Reliance futures, and if the stock falls, the profit on your futures position offsets the losses on your cash holdings. Some traders even use futures for pairs trading, going long on one stock and short on another, expecting the relative prices to converge. That's a more advanced strategy, but futures make it possible. When we shift to the institutional side, the purpose looks similar on paper but plays out differently in scale and intent. Hedge funds and Category 3 AIFs run long-short strategies, often rely on futures for the short side while holding equities on the long side. Large investors like FPIs and mutual funds use index and stock futures to hedge risk across their portfolios, and in many cases, they first take exposure through futures and then gradually build cash positions when the liquidity or impact cost is an issue in the cash market. The arbitrage fund industry is in fact entirely built on futures. These funds exploit small discrepancies between the spot and the futures market by buying the stock in cash market and selling the corresponding futures simultaneously, locking in the risk-free spreads. They may also earn a small additional return from the carry, which comes from the dividends received or differences in financing costs. In the commodity space, futures are a lifeline for manufacturers who depend on raw materials. A copper wire producer, for example, might long copper futures to protect against rising input costs. Currency futures work in a similar way for exporters and importers, though retail participation here has been curtailed. For retail traders, it's also worth pointing out that there's another avenue for leverage beyond futures: margin trading facilities or MTF. It's not really a new product type, but rather a financing arrangement offered by brokers that lets you borrow against your stocks to take a larger position. I won't go into the details here, but I'll point you to the resources where you can explore it further. So far, we've covered listed equities, listed debt, mutual funds, and within derivatives, we've touched upon futures. Now let's move on to options. I've always described options as the Swiss Army knife of financial products: versatile, adaptable, and capable of doing almost anything you need. Futures, by contrast, are more like a hammer: simple, straightforward, and extremely effective at a few specific jobs. Options, however, open up an entire world of possibilities. You can replicate futures exposure using synthetic structures, often at lower transaction costs. You can take more nuanced directional bets, adjusting delta to suit your own risk profile. You can even build trades that have nothing to do with direction at all. For instance, strategies designed to profit if a stock stays within a range, something that no other product allows. And of course, options are unparalleled as hedging tool, whether you want a plain vanilla insurance through puts or a more customized hedge that fine-tunes your delta exposure. On top of these fundamental uses lie an entire ecosystem of structured strategies. Traders combine calls and puts across strikes and expiries to engineer payoffs for almost any market view. Income-focused setups like covered calls or credit spreads, risk-defined directional plays like debit spreads or ratios, range-bound strategies like iron condors, iron butterflies, straddles and strangles, or even time-based approaches such as calendar spreads and diagonal spreads. Each of these structures comes with its own trade-offs in terms of risk, reward, and probability of success, giving options a versatility that no other product can match. In this episode, we learned all about the possible investing and trading products available to us in India. Each of these products have their own specific features and use cases. We figured how listed equity and debt products along with mutual funds can be used to form a solid foundation. And then using derivatives, both futures and options, as a layer on top of that foundation allows us to build a portfolio that is not only robust but also flexible, balancing long-term investing with tactical trading in a structured way. I want to end this episode with an analogy I came across recently: the soldier versus the scout, a concept from Julia Galef's book, The Scout Mindset. She describes two different ways of thinking. The soldier mindset is about defending your existing beliefs at all costs using motivated reasoning to push away anything that doesn't fit it. The scout mindset, on the other hand, is about curiosity and intellectual honesty, seeking to build the most accurate possible map of reality even when it challenges your prior assumptions and beliefs. In many ways, the landscape of financial products in India is no different. Too often, we slip into the soldier mindset, clinging on to borrowed wisdom, old rules of thumb, or strategies we've heard work for others. But reality, as always, is far more nuanced. My aim through this series is to encourage all of us to become better scouts, to question, to explore, and to understand products on their own terms instead of fighting to defend preconceived notions. I hope you found this episode useful. In the episodes ahead, we'll keep building on these ideas step by step. Till then, trade safe and see you soon.